Welcome to another episode of Rich Dad Stockcast, where we're here to help people who are serious about improving their financial education. I'm your host, Del Diddy, and today we have an intriguing topic, stock market myths, separating fact from fiction. Now, as we get started, remember to like, subscribe, and leave your comments below. Your feedback helps us to bring you more of the content that you want to hear. And don't forget to visit stockcastbonus.com for free access to valuable educational resources to boost your financial knowledge. Now, joining us today is Rich Dad expert Andy Tanner. Andy, welcome back to the show.
Thanks much. I'm still getting over a bit of a cold, so if I have a little cough or sniffle, I hope you'll forgive me, but it's great to be here with you, Del.
It's great to have you here. Now, let's dive in. The stock market is full of myths, and separating fact from fiction can be challenging for a lot of investors that are out there. So let's start with some of the most pervasive myths that are out there. Let's start off with one of them. You need a lot of money to start investing. Tell me your thoughts on that myth. I hear it all the time. You need a lot of money to start investing. What would you say to that investor or that person saying that?
Yeah, there's that old saying that says it takes money to make money, and I suppose the reason that's a saying is there's some truth. If you're going to buy something, there'll be money changing hands. But on the other side of that, the amount we could certainly debate, and we could certainly debate on whose money we're investing. So, for example, in the real estate world, we can borrow money to invest, so it doesn't require any of your own. There's most of the people in real estate that are tremendously successful are people that handle both the equity and the debt from other people. They raise the initial equity or the down payment, so to speak, from investors, and they get the rest of the finance from the bank, which leaves them with what they call sponsorship equity. They get a piece of the deal simply for putting it together. So, it takes money to make money, not at the infinite return level, not the high level. In the stock market, let's say someone's starting out. Do you need millions of dollars? Absolutely not. My sons started investing when they were teenagers, even before, probably preteens, but they got serious about it as teenagers. And, they used money from their lemonade stand, for crying out loud. So, and instead of spending it, they invested. I remember during COVID, you could buy stocks for $30, for $4, for $10. And so one of the benefits of getting involved in investing in companies or pieces of companies, shares, is that it's scalable. I have the same companies in my portfolio, many of them, as Warren Buffett does. Do I have as many shares of Coca-Cola as he does? Not even close. But I still get to participate in the same growth and in the same way in terms of ROI and percentage as he does. So, no, people do not need a ton of money to get started. And it's interesting. I think it was Joe Rogan or someone. I don't listen to the podcast, but someone sent me a clip where he was talking about the 1%. We talk about a lot about the 1%. And globally, if you're making like 30 grand, you're in the 1%.
Yeah.
And so we have this standard of living where when I grew up, we had maybe one family car, maybe one telephone in the kitchen. We have a lot more expense. We didn't have expenses like the internet when I grew up. We didn't have a cell phone bill when I grew up. And so, yeah, you can find ways to invest. And when people find that they're good at it and they paper trade, they can start with zero in that instance. Most brokerages now will give you a paper trade account. Just start practicing because they know if you get good at it, you'll find the money to put in there. So the answer is no. Of the three components of compounding, money, rate, and time, money is by far the least important of the three, by far the least.
I love that. To take that a step further, kind of dig on that paper trading. Some people might not know what paper trading is. Can you kind of explain that? And maybe, the question earlier was, it takes money to make money to start investing, right? But you can get started paper trading. What else can you do to get started? What is paper trading? How else can you get started?
Well, I think a great metaphor might be a flight simulator. I imagine nowadays, if a person wants to be an airline pilot, that they'll spend some time in the flight simulator. I know that, the movie Apollo 13, I just loved it. Gary Sinise is in that fake limb. It's a simulation. They ran all these simulations of problems, and when they ran into tragedy, they've got the main bus or whatever, alert, or they're fixing all these problems in a simulation, safe in the simulator, safe in the earth, and or on the earth. Well, the same is true with paper trade accounts. They're simply a simulation that uses real stock market data, real companies, real price quotes, but it allows you to trade as if you had whatever amount of money you choose. You can start with $100,000 if you want, and so it doesn't take any money to start practicing. So that's a huge deal. So and as far as your question of getting started, every episode we offer something on stockcastbonus.com. Go there, and we have ebooks. There's always something interesting there, and it really is designed for people that are new, and even if you're intermediate and want to get better, there's things there for you. So there's all kinds of resources that don't take any money. And then if a person wants to get serious about stocks, they can put some money in the stock market after they practice. If they want to get serious about education, they can invest in their education as well. But to begin, the barriers to entry into this knowledge is really just someone's time, effort, honesty, and sincerity about wanting to get it done.
That's fantastic. I think that's a great 1-2 punch. Get educated, stockcastbonus.com, paper trading, get familiar. I love the analogy of the simulation now, or the simulator. But what about the myth of I want to go into another myth. The stock market's like gambling. There's a lot of people that don't touch the stock market because of that, right? What's your thoughts on that? There's some truth to it, maybe.
I don't know if that's a total myth. I don't know. It can be gambling for sure. Kim Kiyosaki and Robert Kiyosaki, they've taught me a lot about this as I've gotten older, and especially years and years and years ago when I was a younger investor. Risk is related to control. So lots of control, less risk. Less control, more risk. No control, gambling. A gambling instance is once you put your money down on a roulette wheel, it's going to spin, and you don't really have any control once you begin that process. These guys will say, "All right, all bets are off," and we wait and we have our fate determined, or we're playing poker and that river card comes around, or whatever it is. I don't know the jargon. The flop is by chance, right? And we don't have control over what cards we get. So when you look at investing, people certainly can treat it like their own personal casino because they don't have the control that comes through financial education. Now, certainly nobody can buy a share of Apple and force it to go up or stop it from going down. But if a person learns the options market, you can absolutely control your buy price. You can absolutely control your sell price. You can gain a tremendous amount of control on those things. The other thing that there's certainly not an absence of risk in the stock market, but that doesn't equate to the risks of gambling. For example, there's different risks to think about it. The way I think about it on the investing side, and this might be a nice nugget this might be the nugget people say, I'm glad I watched this. This was worth watching because I took this nugget away. My perception of stocks has less to do with price from day to day and price fluctuations, and more about the viability of a business. So, for example, Warren Buffett talks a lot about Coca-Cola. It's one of his large stakes, and he loves that company. And as I mentioned, I have shares in Coke, so I like it. But I don't look at Coca-Cola as a risk of the stock price going up or down. I look at it in a more broad perspective as what are its chances of survival. Now, if you ask me what the chances are of it going up or down tomorrow, I'd say it's 50-50. It could go up, it could go down. It's probably about a 50-50 shot, maybe a little bit skewed to the upside over time. But generally, it's going to be close to 50-50, maybe skewed just a hair to the upside. But if I look at it through the lens of survival and growth, is it going to survive and is it going to grow? I would say absolutely the likelihood is far more than 50-50. This is a company that has what Buffett would call a moat. It was started in 1886. It survived the Great Depression. It survived World War I. It survived World War II. It survived the 60s. It survived the Cola Wars. It survived the assault on Michael Jackson endorsing Pepsi. It survived 9/11, and most recently, survived the subprime meltdown, the global financial crisis, and most recently, it has survived the pandemic. And after all that, if you look at their production, the number of beverages they've sold has increased every decade by leaps and bounds. And now they sell about 2 billion drinks per day. So how do you take that thing down? I mean, if you wanted to be a gambler and you're going to bet against them, you're really gambling, because this is a viable business that it'd be very difficult to say, okay, we're going to stop having people drive through the McDonald's drive-through ordering a Big Mac, and there's going to be a Coke in that in that value meal. So yeah, I don't look at investing as gambling. I don't think it's risk-free. But if you take the position of, I'm going to own a company, are there risks there? Yeah, but it's not like we're rolling the dice where it's a game of chance. We can certainly watch the fundamentals. We can watch what's happening. If we don't like it, we can pull our money off the table. Unlike the roulette wheel, where once it's in, you're in. You're going to make it or lose it. Here, you say, well, I don't like this company anymore. I think I'm going to pull my money back out. And there is a sense of control of whether you participate or not. So yeah, I think the other thing is gambling is really not gambling if you're the casino. If you're the casino, it's a sure thing. You're not gambling at all. You don't know which hand you're going to win in isolation, but over time, the odds are in your favor. So investing, I feel, is more like the business of running a casino, where you're offering, products. In the case of gambling, they call it entertainment, and they're in the entertainment business, right? They're in the business of giving people a thrill or a dopamine hit or a crash or whatever psychological states they want to enjoy. So I don't look at it as gambling at all. I look at it as investing. Can people use the stock market to gamble? Yes, they can. Another thing about investing is while there's risk in cash flow, you don't have to make bets of up or down. You can certainly enjoy a very consistent cash flow. For example, if I were to take ExxonMobil, they've paid a dividend every year, and they've increased that dividend every year for, I believe, I don't know, probably 30 to 40 years in a row, somewhere in that range, probably since I was in high school. And so is that a safe bet? Is there a risk they might stop that trend? Of course, but it's not likely. So gambling, it's investing if you're smart. Has to do with your education and your temperament. The right education, the right temperament is probably what determines whether a person is gambling or investing.
Speaking of temperament, that's one thing I want to touch on real quick before I go on to the next myth. Is there's a lot of emotion in gambling, and there could be a lot of emotion in investing. So how do you control those two when emotion's high, intelligence is low? So what do you do?
I don't know. I don't know that I always do. I'm a pretty emotional. Those that know me know I'm a very emotional guy. I live my life in emotional high definition, you might say. When I laugh, I laugh. When I cry, I cry. When I'm angry, I'm angry. I'm not a very I guess I'm an affective person that way. But you do learn over time to control these things through experience. What should worry you and what shouldn't. Money is a very emotional thing, I think, because people work so hard for it. And this is where the love of money is a root of evil. It's not money itself, but I always tell my kids to be bigger than your money. If you feel driven to make decisions because like maybe someone like Bernie Madoff lies to get money. Well, the money was bigger than his character, right? or maybe a person gets obsessed with the game of one-upsmanship and they lose their character because of it. And if the emotions, whether it's glee or fear or anger or whatever it is, start to take over your life, and money's the underlying reason for that, I think that's a problem. So yeah, how do you control emotions? I think you have a plan. I think you trade the plan, and I think you set out your goals to achieve them for sure. But you engage in a process that's more about having the process right and letting the result vary. When I shoot a foul shot, there's a process to that. The first, I learned this from Coach Krzyzewski. I was in a game, and it was in a camp he was running, and Coach Krzyzewski saw I was pretty worn out. I wasn't in great shape. It was an old man camp, and Coach K pulled me aside. He says, "I'm going to talk to you about your process of shooting the foul shot." He said, "The first thing you want to do is take that full time. You have 10 seconds when they hand you the ball. Take that time before they hand you the ball and compose yourself without the ball. In other words, lower your heart rate a bit, right? Get breathing better. Then once you get the ball, compose yourself once again with the ball, and then do what your normal routine." And most guys have a routine. Adrian Dantley had a weird one, and Jamal Wilkes had a weird one, and Shaq probably should have learned to get one. But for me, I just simply take a breath. I take 3 dribbles looking down. I look up at the rim. I visualize the ball going in once, and then I do it for real. Well, I'm probably about an 80% foul shooter. My son's about a 90% foul shooter. So that means 10% of the time he's going to miss right now at his level where he's at. And I've always told him, I says, we're not going to get emotional about whether the ball goes in or not. We're just going to know that if we're tight with our process, we'll have 90% success, and that's good enough to win. That's good enough to win most games. And so in the book Toughness by Jay Bilas, he talks about that. It's a great book where he says, look, if you concentrate on being passionate about your process and then you detach yourself from result, that's a great way to handle the emotions and pressure of, did I make money in the stock or did I lose money in the stock? I say, look, if I go through my fundamental analysis, it fits my technical criteria, I understand my cash flow position, my risk management, and those are the 4 pillars, right? If I follow my 4 pillars, I know I've done it right. I'm going to have some losses, but that's okay because I'm going to have more wins than losses. And that's how I think you can eliminate a little bit of emotion from it.
Great advice there. Great advice. I love that. Well, let's do this. We're going to take a quick break, but listeners, don't go anywhere. We've covered some of the basics of the stock market myths, but when we come back, we're going to debunk some more myths as we come back. Andy's going to share his expertise with us. Stay tuned.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad Stockcast. I'm your host, Del Denny, and today we're discussing stock market myths. Now, before we continue, don't forget to check out StockcastBonus.com for free resources that can help you take control of your financial future. In fact, Andy, tell me, what can we expect from StockcastBonus.com?
We from time to time we'll put different things out there, different bonuses that we think are relevant. Right now, if you're watching this recently, it may have changed if you're watching this later, but right now we've got a great ebook, and you really want to check this out because it's free. And what it does is it helps you really map out your rat race escape plan, and it'll help you turn a dream into a project. And so it's an exercise that you'll go through where you'll have the chance to see where you are now, visualize where you'd like to be, and then create an exercise. It's interactive, where you'll see the roadmap. You'll actually see the terrain, so to speak, of A to B, how far it is, how fast you can get there, what it's going to look like. Because a dream is just, well, I'd like to, fly to Paris with my wife every year, first class, and stay in the Four Seasons. That's a dream. when you price it out and you see where you are now and what it costs, as soon as you put a price on it, on a lifestyle, it becomes a project that can be worked on and moved towards. So it's a fun bonus. Make sure you get it. And the feedback we have on it's been fantastic. So we thought we'd offer that as for this episode in the Stockcast bonus. So check that out.
Oh, that's great. Now let's do this. Let's jump back into the myths. There's a myth of high risk always means high reward. High risk, high reward. What's your thoughts on that? Because I think that it's a little bit dangerous thinking that way, but
yeah,
is that true?
I think there's certainly, I mean, we wouldn't have risk reward ratios. We wouldn't have a Sharpe ratio. We wouldn't have those metrics if there weren't a correlation generally between risk and reward. But there's some problems with that. And I think it's unwise to say, well, that's a law. You know, it's often a correlation, but it's not a financial law like gravity would be. There are so many exceptions to the risk reward principle. And I'll give you just two that I think this might be another nugget where people say, man, I'm glad I watched this because it can help your thinking. First of all, when we talk about risk reward, we place ourselves in an improper context as if your success were to rely on the investment. For example, someone might say the risk to reward of putting money in a savings account is very low. You have very little interest, but your dollar will probably be worth $1 tomorrow. If inflation is not too bad. Where someone might say an option is tremendously risky, you could lose all your money, and or the forex is crazy, and there's so much leverage. And notice here we're talking about investments. But if you want to have success, don't talk about investments. Talk about investors. For example, it is less risky for, let's take a member of my team, Corey Holliday. Here's a Series 4 option principal. He's been in the market his whole adult life. He's he was a risk manager. He worked for a Wall Street firm for a number of years, managing a floor of hundreds of traders. His job was to look at all their individual trades and manage the aggregate risk in that firm. Okay, now let's take my mom, who has never invested in her life, right? And I say, okay, Mom, you go buy a mutual fund, which is supposed to be not risky, and then you let Corey trade some options. I'd go with Corey every time because my mom doesn't know what she's doing. So I look at a risk reward. Sure, there's certain elements of an investment that could bring a big reward, but they could cost you more if they went wrong. That's the true part of that thing. That's the non-myth part, is that I certainly can find investments where the money that could come into me is larger than other investments, but the money I could lose is also larger than some investments. So that's absolutely true. But that has to be put next to, or there needs to be a juxtaposition of the investor as well. Certainly Warren Buffett is doing things above the pay grade of most people that will bring greater amounts of money. And if he did them wrong, they'd have greater amounts of risk. So think of it this way. Think of an airliner going to Hawaii as opposed to a bicycle going to the park. Well, if my son gets on a tricycle and wants to go a block to the park under my supervision, that's pretty safe, and yet you don't get many places. Now imagine an airliner and how complex that is and what's at stake. If my son is riding his tricycle and he hits a bump in the road and falls off, chances are he'll survive that. Or if the wheel fell off, a bolt comes loose and the wheel fell off, he'll probably survive that. You have something going wrong in a 747. That's a big metal tube at 30,000 feet going 600 miles an hour. People are going to die. And yet, it's probably the safest way to travel. There's probably been more people killed on their tricycle or bicycle getting hit by a car than that have died in an airline crash. Well, why is that? I mean, it's great reward, it's great risk, but why is the probability of success so high? And that's a real important thing to insert into the risk reward discussion. Is there's huge rewards here, there's huge risks, but what's the probability of success? Well, the probability of success often comes down to who's driving. And the pilot has an education to handle that advanced equipment, handle that tremendous thrust and leverage and power in a very risk. The risk is of an airline is huge because you have something going. It's death. I mean, that's the biggest risk you can have is death. But the probability of the success of the flight is extremely high. So when you insert, the investor and the education, and also consider the probabilities, that changes that risk reward discussion significantly. And so that's a big deal. And then finally, I will tell you it's not a law. I'll finish that long-winded answer to this question with this, is actually the greatest reward is infinity. It's an infinite return. That's the biggest percent return you can get, division by 0. And by nature, since you're investing with no money, you have no risk. And these people are going to say, Andy, you're full of crap. There's no such thing as an infinite return with no risk. And yet the truth is they're all around us. One need look no further than the 401k system to find infinite return with no risk on the side of the financial institutions. They supply none of the money, so they can't lose any. Since they're not investing the cash, they can't lose any. They take none of the risk. That's all on the part of the investor. And yet they get the fees no matter what. So they're going to get paid with no investment, with no aspect of the direction of the market. They have a 100% win on that, and they receive an infinite return, and they take no risk. So they have an investing or business model of absolutely risk-free with an infinite return. Well, that's exactly the opposite of what you mentioned, that a high risk or a high return requires a high risk. No, it doesn't. They have an infinite return and they have no risk. And that can be spun in my new edition of 401k. If I can plug that, it's going to come out in about a year. I've finished it. They've asked me to do a new version of it. I'm done, but the editors and the publishers are doing their thing, and the promoters got to get this stuff together. So in about a year, it'll come out. But in that book, I talk a lot about taking that lesson and following it on your side and finding investments that can give you infinite return with no risk. And I have several of those in my own life. So the idea of risk reward is a myth if you want to make it a hard, fast law rather than just something to learn from, that, oh, here's an investment that has a large potential reward. If it goes right, and if it goes wrong, it has a large potential loss. That's where that discussion ends. It's where the other discussion should begin.
Now, you mentioned, kind of using your words, putting your faith in the pilot, putting your faith in other people, putting faith in yourself sometimes. Now, there's a myth of only experts, only the guys on Wall Street or the gals on Wall Street can invest successfully. The average Joe like myself can't do it. We got to lean on those Harvard educations. What do you say to that?
I let people do what they want. There's, in the first edition of my book, 401 Chaos, I touched on this. I didn't touch on it in the second. Maybe I should have. But there's decisions for everyone listening and watching to make about what you want to be good at. And you could create two distinct domains, really. You could have a domain where there are things that are for hire, and a domain for things that you want to do yourself. For example, I could hire a chauffeur. I could hire an Uber driver if I wanted. Or I can say, no, that's a skill I want to have. I want to be able to drive if I choose to. And then if I want to hire someone, I can know whether they're doing a good job or not, right? So is driving a life skill or a skill for hire for you? Tying your shoes. I can have my mother tie my shoes my whole life. And knowing my mom, she'd be happy to do it. She thinks I'm perpetually 7 years old anyway. So, if I asked my mommy to tie my shoes, she'd say, oh, sweet little Andrew, I'd love to. But tying my own shoes is something I want to do. Now, if I want to do a root canal, doing that on myself, for me, I've chosen to have dentistry a skill for hire. I didn't go to dentist school, something I was interested in. Don't want to dedicate my life to it. I brush my teeth. That's a skill I've learned. I have my little car wash that I use, my little, water pick, super, water all over the place. And that's the extent of my responsibility on that. But if I happen to get a toothache, I'm going to the dentist. So the question is what about investing in money? Is investing something that A, is important to you, and B, that you would enjoy spending some time doing? Is that a skill for hire, or is it a life skill? Let's say that again. Is that a skill? Is financial education a skill for hire, or life skill? Well, if you choose the former, say it's a skill for hire, you'll pay what we call fees, and you'll fall into what's called assets under management of Wall Street. People convolute Wall Street and Warren Buffett as being in the same domain. They couldn't domain. There couldn't be more different. Buffett pays no fees to Wall Street. He doesn't. He does not ask for advice. He has his assets under his own management, not under the assets under management of Vanguard or Fidelity, or whatever. He owns those stocks. I am the same. I have my assets are under my management, and so I'm not going to pay mutual fund loads and fees, and all those types of fees. And so that's the question. If you decide to trust Wall Street, you're really taking a risk because you have no control over that. You've given control to them. If you're ignorant, maybe that's a better way. But if you have any intelligence at all to answer your most important question, is can the average Joe do this? Well, I don't know. I feel like I'm an average Joe, but I'll leave that up to the listener. If they want to have an attitude of, well, I'm just too dumb to do this, well, what are they tuning in here for then? If they've lost hope. But if you can, learn a computer and how to send an email, you can learn how to send in an order. If you can, read a newspaper and understand an article, you can read a financial statement. And if you can play the cash flow game and get out of the rat race on that board game, you have the basic understanding of how investing works, and you can always learn. So I leave it up to people to decide what they want to do. I'm not here to try to save anybody or give them a pep talk. My opinion is that anyone can learn this if they want to, if it can be made simple for them. My sons have learned it, but is it a myth that everyone could learn this? Well, everyone doesn't, and I'll leave that up to the listener to decide. Where do you want to be? What do you want to do?
All right, last question, lightning round. If there's one myth that we haven't covered that you want to tackle, what would it be?
That you can be wealthy without knowledge, unless you inherit it. And even if you inherit it, you leave it. I hate the idea of a 401k. I don't know anyone who was self-made that did so in ignorance. The idea that someone can just invest in a 401k every month and build tremendous life-changing generational wealth, that's a huge myth. The idea that Wall Street knows better than you is a huge myth. The idea that that you have to, have a, that there's some type of privilege you'd have to have by your parents or whatever, you have to be granted wealth because mommy and daddy were wealthy. That's a complete myth. Most millionaires are self-made. The vast majority of them are self-made. Even the most billionaires, the vast majority are self-made. And so the idea that a person's going to get wealthy without education, mentorship, work, effort, that they'll get something for nothing simply by hoping that things will change, that's a myth. But I would say that's the biggest one, is any notion that a person is going to create wealth without learning things. That's a complete myth. And that's what's implied in the 401k program in the United States, and the RSP in Canada, and the super in Australia. Is they say, look, just go be a worker bee, put your money in this thing, and you can have abundance. And the numbers show that it's not. Vanguard's recent report said that a person in the age group of say 55 to 64 rated for retirement got less than $90,000 in there. That at the 4% withdrawal rule is less than $300 a month in retirement. That's not abundance. And so the idea that this saving and this being on this schedule of handing money to Wall Street is going to make you rich, that's if you look at the median balances, it's a complete myth. It's just not reality. It's just a fact. So there you go. Beautiful. Great discussion, Del. Great discussion.
Well, thank you. This has been so enlightening, but that is a wrap for today's episode. We hope, listeners, that you found this very educational, and again, a big thank you to Andy Tanner for sharing his expertise with us. Andy, it's always a pleasure to have you on the show. Remember, whether you're just starting to invest or you have years of experience behind you, the key is to stay informed and educated. And speaking of education, don't forget to visit stockcastbonus.com for free resources that can help you on your financial journey. And if you've enjoyed today's episode, please make sure to like, subscribe, leave us a comment. Your feedback helps us to improve and bring you more of the content that you want to hear. Share this podcast with your friends, your family. It might just help them to make better financial decisions too. Thanks for tuning in to Rich Dad Stockcast. Until next time, get smart, get invested, and get control of your financial future. I'm Del Denny, and we'll see you on the next episode.
This podcast is a presentation of Rich Dad Media Network.